And you guys, my profiteers, I got to let you know, if right now you're hoping and praying that you're going to get all the interest in the world from doing that CD or leaving your money in that savings account, you, my friends, are going to get screwed. You see, a year and a half ago, things were great for a savings account. A 1-year CD paying 5.5%, sometimes 6%. Those days, my friends, are gone. You need to have your money invested because inflation is going up and now the rate at your bank is going down. A savings account right now as we speak, 0.4%. I got $100 today. I'm making 40 cents. What? 40 cents? Yes. A money market account right now paying no more than 4%. $100, I'm making $4. I feel good about that. But a few things, my friends. Number one, inflation. You see, inflation, it's not going down, it's going up to the tune of 3%. So I make $4 in my money market, but I lose $3 with inflation. I only made $1. How can I live off of that? Number two, taxes. In a non-retirement account, that money market account is being taxed at ordinary income. So if I'm still working, I'm in the 24% tax bracket per se. For every $100 I make, $25 goes to the IRS. That means, my friends, I'm actually losing money if you include inflation. And who does not include inflation? It is the silent killer. So the Fed lowered rates, which is great for some, but it hurts for others. So we're going to talk about that specifically, the good, the bad, and the ugly in this episode. Y'all ready? Lego.
And you just wanna get paid. Tired of making the money mistakes. Make a payment on your bills and you still late. Yeah, Payneful Profits to help you seek change. And you just wanna get paid. Yeah, tired of making the money mistakes. Make a payment on your bills and you still late. Payneful Profits to help you seek change. Yeah, cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours.
Before we get started, as always, like, share, subscribe. In real life, I'm a certified financial planner. We help thousands of clients worldwide with increasing their net worth and decreasing their tax liability, but on these social media airwaves, we're giving information. And this information, my friends, you got to take heed to. So the good of the Fed lowering rates. Well, my friends, the housing market for a buyer is going to tick up because mortgage rates will be going down. And when they go down, what happens? We buy, we lend. Banks do at least. We're not lending unless you're doing hard money loans, which we do. We buy cars because interest rates are going down as well. But we're talking about houses right now. And when it comes to houses, you're going to see a lot more individuals buying houses. So what does that mean? If we have more people trying to buy, is that good for sellers as well? Yes, because it might be a competitive situation. And now that $400,000 house, it might be two people arguing. So we might be able to push it up to $425,000, which is more money for the sellers, more money for the realtors on the seller and on the buyer side as well. So that's good. Another good thing is the stock market. Well, we love to use history when it comes to investing. And yes, past performance does not guarantee future results. But since 1980, the S&P 500, the benchmark when it comes to stocks, has been up on average over the 12 months after the Fed cut rates by 14%. That's the average. Historically, over the same time period, the stock market in totality has made 9%. So when the Fed cuts rates, historically, the market does better. Now we have stocks that do a lot better and we have stocks that do worse. But on average, we may see the market going up more than it usually does, which is piggybacking off of this year. Right now, this year, the S&P 500 is up by 18%, doubling its average of 9% a year. So my investors out there, My stock market investors, my clients, woo-hoo-hoo. Fun times when it comes to the Fed lowering rates. Now, of course, we always like to think with the chart, not with our heart. So let's spread this out all the way from 1929. From 1929 to 2019, 90 years if you adjust for inflation. So not just since 1980, but over the past 90 years, if you include inflation, the market has went up by 11% the following 12 months after the Fed first cut their rates in 1929. This is an investment opportunity of a lifetime. And if you include artificial intelligence and companies using AI to increase their profit margins, the next 12 to 18 months might be the biggest investment opportunity we've ever had in our lives when it comes to the stock market. That, my friends, is good. So, I mean, it has to be nothing but good news. The market has a possibility of going up, outperforming its historical average. We're going to be buying more cars, more clothes, not more clothes, of course, but we're going to be buying more houses. Housing prices going to go up. That's a good thing. So what's bad about this? Oh, my friends, it's bad in this as well. When the Fed lowers rates, it's not all good. In the words of Mary J. Blige, I'm going down. And that's what the Fed did. But when that happens, we usually have a uptick of inflation. And the reason why is because lowering rates makes borrowing cheaper, as we talked about. It's cheaper to get money. And also, the banks are more lax when it comes to who they give their money to. They might give a little bit more to people than they're supposed to, or it might be people that really shouldn't get that funding, but they do. And it tends to then increase spending. We're spending more money than what we should because things are lower. It also increases investments, which is good. The right investment, not the wrong investment. And that also boosts demand. We have this thing called supply and demand. Same supply, more demand, things go up. People get priced out, and what happens? Inflation can tick up. And if supply can't keep up with everything, that's pushing inflation to the moon. And we have history to prove that. 2020, COVID, 2021, interest rates going to zero. What happened in 2022? Inflation at a 50-year high, the quickest spike in inflation in our history. Now, I'm not saying 2022 is going to happen next year or the year after that, but when we lower rates, that sometimes is not good because of that pesky thing called inflation. Also, from a debt standpoint, us lowering rates mean our debt, you know, how much we owe everybody else as a country, that goes up. And I don't think that's a good thing for anybody. The more debt that you have as a person or as a country, that's not a good thing. That's a bad thing. The last bad thing about the Fed lowering rates is it reduces the returns of savers. You know, people who don't want to be in the stock market, they just want to save their money. They just want to put it in a high yield savings account or a CD or a treasury bill or something that's quote unquote safe, whatever that means. Because safe might feel safe like you're not losing money, but you're losing buying power because of inflation. But for those individuals, guess what happens? Retirees in particular, savers rely on income, and that income is really not there because of the lowered interest rates. So households that were able to pay for things may not be able to pay for the same things, or they got to go into the savings and checking account to get more money to pay for the same things because of them not making as much money. And that, my friends, is also bad. So we have the good and we have the bad, but then, my profiteers, we have the ugly. And this can truly get ugly. Well, my first year in the business was 2007. My second year in the business was 2008. And my third year was 2009. And I have to tell you, 2008 was a doobie. The Great Recession. And why did that happen? Because we had a stock market bubble that burst, as well as the housing market. What factored into that? Tech taking over. That's kind of happening right now with AI. Also, the housing bubble because of low interest rates, boop, popping. And with the laxness of this administration, not being political, but the laxness of policies and letting banks, lending institutions really kind of get away with lending that maybe they should not have, that, my friends, is a recipe of a bubble. Now, I'm not saying it's going to be a bubble bursting, but the ugliness about the Fed lowering rates is that inflation can cause a bubble to be bursted. The worst case scenario of all worst case scenarios. Housing, which was kind of gets over leveraged and pop. Midterm elections, 2027. And then the stock market. Not because of companies' valuations, but because the year 2025 and 2026, it was so great, it returns to the memes. Now, 10, 15, 20 years from now, the stock market is going to be higher than where it is today. So I'm not saying take all your money out the stock market. Far from it. What I am saying is it's good to know what's happening in the future so you can prepare yourself. So the ugliness about the Fed lowering rates is cheap money encourages risk taking. And when we are more riskier, that bubble gets bigger and bigger and bigger. And then, my friends, it explodes. The housing market may heat up because lower rates, more demand, that equals higher prices. Who can afford those higher prices? Especially if AI continues to take away people's jobs. Look at Amazon. 30,000 people cut in one day, the biggest cut ever. Diabolical by Amazon, by the way. Do you think lowering rates will help companies make those decisions because they're making more money, because they're born with less? Or is it going to hurt them by making these decisions? It's going to help them. They're going to lean into that because they're going to have a bigger profit margin. So because we have a lot of new investors because things are so low, and we have companies making more money with an increased profit margin, the market going up, the housing market going up. If, and I say if, the administration, Congress, and banks don't keep things level, inflation is going to go sky high. When that happens, my friends, the housing market and maybe the stock market. Phew. Now, what does that mean? I'm not saying that we're going to have 2007 or 2008 or 2009. The market goes down by 20% or more once every 2 years. And guess what, my friends? It's done it in 2000. Yes, COVID. In 2022, the inflation bubble. And then this year, tariffs. So the market was probably going to go down anyways in 2027. I don't know about 2026, maybe, maybe not. So it was going to happen. So what you need to do is to prepare for it. How do we do that? Because we know the good, the bad, the ugly. Well, number one, we want to take advantage of these lower rates. If we want something that's going to cash flow, we're close to retirement, want another stream of income, now is the time to buy that rental property. Not next year, now, before houses go up and interest rates are going down right now. If we want to get into the stock market right now, probably the best time. 6 months from now, a year from now, historically, the market's going to be higher. We want to buy lower or buy higher. Also, we want to be diversified, not putting everything in one asset class because if that bubble does burst, our money is spread out. Also, we need to make sure we're using a certified financial planner like myself to help navigate those decisions because next year it's going to be animal spirits. Everybody's the smartest person because the market's going up like crazy and their house is going up like crazy. It happens. So you need to have, on the left shoulder, angel's advocate to make sure we're doing the right decision. And from a taxation standpoint, you have to have a tax strategist like myself. So you can take advantage of those investments, because how you invest your money, i.e., the stock market, real estate, or in a new business, how you're structured goes a long way in how much the IRS will pay you back for taking that risk of investment. So, my friends, the good, the bad, the ugly, the question is, are you going to take advantage of this opportunity of maybe a lifetime because of housing, AI, and the stock market? If not, shame on you. If so, click the link and comment in the bio, Wealth, WEALTH, and we'll give you a blueprint on how to prepare for the Fed lowering rates and how you can profit from it, either in stocks, real estate, or in your business. As always, love is love. Let's make some painful or painless profits together, y'all. Peace.